Scotland's housing market was once seen as a calm refuge, cheaper homes, strong rental demand, and steady appreciation. But beneath that calm surface, 2025 is revealing serious cracks. From rising flood risks and stalled developments to new short-term rental bans and sluggish wage growth, parts of Scotland are becoming property time bombs waiting to go off. In this video, we're exposing 10 Scottish towns that might look like smart investments today, but could become financial traps by 2026. These aren't the remote villages you'd expect. Some are popular commuter towns and holiday hotspots that are already starting to lose value. If you're thinking about buying in Scotland this year, watch this before making a move, because what's coming could leave thousands of buyers stuck with homes they can't sell. Let's dive in. Inverness, often called the capital of the Highlands, has long been a symbol of balance between natural beauty and modern living. For years, it attracted families and retirees looking for space, peace, and connection to Scotland's rugged landscapes. But by 2025, that dream is starting to show cracks. Property prices have surged more than 30% since 2020, far outpacing local wage growth. The average home now costs around £235,000, an amount well beyond what most local earners can realistically afford. What once looked like sustainable growth has turned into a bubble propped up by tourism, remote workers, and second home buyers. The city's economy is heavily reliant on two fragile pillars, the public sector and tourism. Both have been hit by budget constraints and unpredictable market swings. If either falters, the property market could face a sudden slowdown. Adding to the pressure is the strain on infrastructure. Roads, schools, and services haven't kept pace with the city's population growth. In areas like Milton of Leys and Culloden, new developments are priced far above the local average, yet still find fewer buyers than expected. Meanwhile, short-term rental restrictions are looming, cutting into profits for Airbnb investors who once saw Inverness as an easy income stream. Combined with high mortgage rates, rising energy costs, and fewer tourists spending money locally, sellers are starting to outnumber buyers. For those who bought during the boom, the danger isn't immediate collapse, it's slow deflation. Values stagnate, demand weakens, and suddenly that dream Highland home becomes a long-term liability. Inverness may still look idyllic on the surface, but beneath that calm, the warning signs are flashing bright red. Fort William has always been a magnet for adventure seekers and investors chasing the Highland dream. Nestled at the foot of Ben Nevis, it is one of the most scenic places in Scotland. But that natural beauty is now masking growing economic fragility. In recent years, the town's property market has been driven almost entirely by tourism and second home ownership. When interest rates rose sharply in 2023 and 2024, it was these very owners who began to feel the squeeze first. The town now faces a classic boom and bust cycle. As regulations tighten on short-term lets, many landlords have been forced to sell or shift to long-term rentals, flooding a small market with too much supply. Once that balance tips, prices fall fast. Many properties that sold easily in 2021 are now sitting unsold for months. Local wages, among the lowest in the Highlands, simply cannot sustain the inflated prices left behind by outside investors. The tourism industry, Fort William's lifeblood, is also feeling the strain. Rising travel costs, unpredictable weather, and staff shortages are cutting into profits. Businesses that once brought consistent income to the area are scaling back operations, meaning fewer jobs and less stability for the local population. As younger residents move away in search of better opportunities, the demographic tilt toward aging homeowners grows, reducing long-term market vitality. By 2026, Fort William could face a housing landscape defined by empty properties, stagnant demand, and falling prices. Investors who once saw it as a safe bet may find themselves locked into mortgages on homes that no longer yield returns. What was once Scotland's outdoor paradise might soon become a cautionary tale about the dangers of over-reliance on tourism and speculative property buying. Dundee's transformation from post-industrial decline to a creative hub was one of Scotland's biggest success stories of the past decade. The waterfront regeneration, new cultural landmarks like the V&A Museum, and growing tech and gaming industries gave the city a sense of optimism that rippled into its housing market. Between 2018 and 2024, property values climbed more than 40%, turning Dundee into one of Scotland's most talked-about emerging cities. But that surge is now showing clear signs of slowing, and perhaps even reversing. The biggest problem is overvaluation. Rapid price growth wasn't matched by local income increases, leaving many residents priced out. New developments, particularly high-end flats and student-focused accommodation, have oversaturated the market. Investors, especially from outside Scotland, piled in during the boom years, expecting endless demand. But those expectations are now colliding with economic reality. Mortgage costs remain elevated, rental yields have dropped, and many of those shiny new flats are sitting vacant. Even the student housing market, once a reliable source of rental demand, is softening as universities tighten budgets and international student numbers fluctuate. Meanwhile, household budgets across the city are stretched thin due to the cost of living crisis. As buyers pull back, sellers are cutting prices, but not fast enough to reignite activity. Dundee's economy, while diversified, is still small compared to major Scottish cities. If national growth stalls or unemployment ticks up, the city's housing market could experience one of the sharpest corrections north of the border. By 2026, Dundee's story might shift from Scotland's creative comeback to Scotland's cautionary tale, a reminder that even promising cities can become dangerous investments when speculation outruns substance. Has become both its legacy and its liability. When crude prices crashed in the mid-2010s, the city's once thriving property market collapsed alongside it. Between 2015 and 2020, average home prices fell by more than 25%, wiping out a decade of gains. While there has been a mild recovery since, confidence in Aberdeen's housing market has never fully returned. The local economy remains in transition. The oil and gas industry, long the region's lifeblood, is shrinking as global energy priorities shift toward renewables. Thousands of skilled jobs have vanished or moved elsewhere, leaving a gap that green energy projects have yet to fill. The energy transition offers promise for the future, but it's not happening fast enough to support housing demand today. With fewer high-paying jobs and a population that has been gradually declining, the market's foundation feels weaker each year. Rental yields, once among Scotland's highest, are also slipping. As landlords exit due to tighter regulations and softer rents, the buy-to-let market that once sustained Aberdeen's property boom is losing momentum. Average prices hover around £200,000, it sounds. But stagnant wages and a high cost of living have eroded affordability. Meanwhile, oversupply from the oil boom years has left many apartments sitting vacant, particularly in city centre developments built for corporate tenants who no longer exist. By 2025, Aberdeen finds itself at a crossroads, not quite in decline, but no longer a city on the rise. Until the local economy diversifies and stabilizes, housing values will likely continue to drift or even fall further. For investors and buyers hoping for a rebound, patience, or caution may be the wiser strategy. Stirling's postcard-perfect scenery and central location have long made it one of Scotland's most desirable places to live. Positioned between Glasgow and Edinburgh, It became a commuter's paradise during the past decade, especially as buyers fled city prices during the pandemic. But as we approach 2026, Stirling's housing market shows signs of strain beneath the surface. Average home prices have surged to around £280,000, a steep climb relative to local earnings, which remain below £40,000 on average. That disconnect has made Stirling one of the least affordable smaller cities in Scotland. The local market was built on a key assumption that people would keep commuting to the big cities. But hybrid and remote working trends are reshaping that logic. Fewer buyers now see proximity to Glasgow or Edinburgh as worth paying a premium for, and that change could puncture Stirling's price advantage. Speculative investment has also crept into the picture. A rising number of buy-to-let landlords entered the market in recent years, chasing rental income from students and commuters. Yet rental growth has slowed significantly, and tighter lending standards have cooled investor enthusiasm. As mortgage rates remain high, first-time buyers are retreating while listings quietly climb, a combination that typically precedes a correction. Stirling's fundamentals remain strong. It's beautiful, well-connected, and historically stable, but the housing data suggests a peak has been reached. When prices climb faster than wages and demand weakens, markets tend to rebalance. By 2026, Stirling could transition from a hot-ticket investment to a market adjusting to more realistic values. Oban's setting is breathtaking, a coastal gem on Scotland's western shore, often described as the gateway to the Isles. Yet behind its scenic charm lies a property market increasingly out of touch with local reality. The average home now costs over £300,000, a price completely detached from the town's modest incomes and seasonal employment base. Much of this inflation stems from the boom in holiday homes and short-term rentals. For years, investors from across the UK viewed Oban as a perfect escape, an idyllic spot that could double as both a personal retreat and an Airbnb cash generator. But this surge of external ownership has squeezed locals out of the market and hollowed out the year-round community. Population decline has become a persistent issue since 2016, with younger residents leaving due to limited housing and scarce career opportunities. Now the landscape is shifting again, and not in Oban's favour. Scotland's new short-term let licensing rules have made it harder to operate holiday rentals profitably. Many investors are being forced to sell, just as demand weakens under the pressure of high interest rates. Flooding and coastal erosion risks add another layer of uncertainty, with some properties facing rising insurance costs and potential devaluation. What's unfolding in Oban is the classic reversal of an overheated second home market. When tourism slows and regulation tightens, supply floods in while real demand evaporates. Prices may not crash overnight, but stagnation followed by a slow decline is increasingly likely. By 2026, Oban could find itself with too many unsold holiday homes and too few full-time residents, a town that remains beautiful, but economically brittle. Perth has built its reputation as one of Scotland's most livable small cities, clean, walkable, and perfectly positioned between Edinburgh, Glasgow, and Dundee. That location helped it become a commuter haven during the pandemic, when buyers fled urban centres for more space and cheaper homes. But by 2025, the data paints a very different picture. Property prices have climbed around 23% since 2019, while local wage growth has been almost flat. The result is a widening affordability gap that leaves many residents priced out of their own city. At first glance, Perth's market still looks healthy. Houses are selling, and the high street buzzes with activity. But underneath the surface, cracks are forming. Mortgage costs are eating into disposable incomes, and first-time buyers are struggling to qualify for loans. Developers, still chasing the last wave of demand, continue to build at full speed. This oversupply is beginning to outpace real demand, especially as hybrid work reduces the commuter flow to Edinburgh. Local industries, from hospitality to retail, are also under cost pressure, limiting wage growth and employment stability. For homeowners, that creates a dangerous feedback loop. High prices, low affordability, and few new buyers entering the market. Historically, Perth's property sector has been steady rather than speculative. But when prices outstrip fundamentals, correction becomes inevitable. If current trends continue, Perth could experience what analysts call a silent correction, a period of stagnation where nominal prices hold, but real values erode under inflation and falling buyer power. By 2026, homes may still look desirable on paper, but the number of qualified buyers will have shrunk dramatically. For investors banking on continued growth, Perth's calm exterior might soon conceal a slow but steady decline. Ayre's long promenade and seaside charm make it one of Scotland's most picturesque coastal towns. Yet the same coastline that draws tourists and retirees is becoming its greatest vulnerability. The town's economy leans heavily on tourism, hospitality, and seasonal trade, sectors that have been battered by inflation, unpredictable weather, and higher operating costs. Visitor numbers have dropped in recent years, and local employment opportunities have failed to keep pace with rising living expenses. While Ayre's housing prices remain relatively low, averaging around £190,000, so too are local incomes, which means even modest increases in mortgage rates can strain household budgets. The town's aging population compounds the issue. Fewer young buyers, fewer families, and less demand for long-term housing. For a market to remain healthy, it needs turnover. But Ayre's is slowing. Environmental factors add another layer of risk. Flooding and coastal erosion along the Firth of Clyde have become a growing concern, with insurance premiums for some seaside properties tripling in recent years. This not only increases ownership costs, but also makes certain homes harder to sell or insure altogether. Developers have been hesitant to build new stock, leaving the town reliant on older, less efficient properties that require expensive upkeep. The result is a fragile equilibrium. Prices haven't crashed yet, but the ingredients for decline are all there. Stagnant wages, environmental exposure, and dependence on a single unstable sector. If Scotland's broader economy slows further in 2026, Ayre's housing market could tip from stability into contraction. What looks like an affordable seaside retreat today might soon become a depreciating investment tied to an aging, shrinking economy. Kirkcaldy, once a thriving industrial centre on Scotland's east coast, has struggled to reinvent itself in the modern economy. While affordability has drawn new residents in recent years, it has also masked deeper structural weaknesses. Average property prices remain below the Scottish average, roughly £170,000, but local wages and job opportunities haven't improved meaningfully. As a result, many first-time buyers who stretched their budgets during the pandemic boom now face higher mortgage payments and falling equity. During 2020 to 2022, Kirkcaldy saw a brief surge in demand as remote work made smaller towns more attractive. But that trend has faded. Younger residents are once again moving toward nearby cities like Edinburgh or Dundee for better pay and lifestyle opportunities. This population drain reduces housing demand and limits the town's ability to sustain price growth. Another concern is aging infrastructure. Much of Kirkcaldy's housing stock dates back decades, and energy efficiency standards are becoming stricter. Upgrading older homes to meet new EPC requirements will be costly, a burden many owners can't afford. Without significant new investment or regeneration, the area risks falling behind as buyers prioritize modern, efficient properties elsewhere. By 2026, Kirkcaldy may face the same challenge as other post-industrial towns. Too much aging stock, not enough economic momentum. Prices could stagnate or decline, leaving many owners trapped in homes that are difficult to sell. The town's affordability once seemed like its strongest advantage, but without strong local demand or new infrastructure, it could become its biggest weakness, a market where low prices simply reflect low confidence. Greenock tells a story familiar across Scotland's old industrial belt, one of resilience, but also steady decline. With average home prices around £130,000, it's one of the most affordable places in the country. Yet cheap does not equal value. The local economy remains heavily reliant on manufacturing and logistics, both of which are facing automation, overseas competition, and rising costs. Job losses over the past decade have chipped away at the town's population, and younger workers continue to move south in search of better prospects. For property buyers, that shrinking population poses the greatest risk. Fewer residents mean weaker long-term demand, leaving little upward pressure on to prices. Many homes in Greenock are older and require extensive maintenance, which quickly erodes any upfront bargain savings. Investors lured by low entry prices often find themselves stuck with properties that are hard to rent, harder to sell, and expensive to maintain. Compounding the problem is limited infrastructure investment. Public transport links remain patchy, and while the town's waterfront regeneration has helped cosmetically, it hasn't created enough jobs to drive sustainable growth. Crime and vacancy rates remain higher than average for Scotland, deterring outside investors who might otherwise see opportunity in the area's affordability. Greenock is a classic value trap. It looks like a deal, but without economic vitality, there's no real upside. By 2026, continued outmigration and stagnant wages could erode even the modest gains of the past few years. For anyone considering buying here, the warning is simple. Affordability alone doesn't make a market safe. In Greenock's case, it may be a sign that demand has already left and won't be coming back anytime soon. Before you even think about buying property in Scotland, remember this. Cheap doesn't mean safe, and growth doesn't mean guaranteed. What looks like a quiet market today can turn into tomorrow's financial trap. We've built our own breakdown showing where the next Scottish housing shock could hit first, and we're updating it in real time. So if you want to stay ahead of the curve, subscribe right now before the next correction begins. And tell me in the comments, which Scottish town do you think is the next to fall? Inverness, Dundee, or somewhere no one's talking about yet? Let's see who spots the warning signs before the headlines do.